Market correction. Major firms offload acquisitions at substantial losses amid new economic realities. In an economic climate marked by abrupt reversals and reassessments, various companies that once engaged in heavy acquisition sprees are now divesting these assets at significant losses. This trend underscores a broader market correction and a shift toward more prudent financial management after years of speculative investments fueled by low interest rates and competitive fervor. Alibaba Group Holdings' recent divestiture of the Chinese department store chain Intim is a case in point. Purchased in the optimistic economic climate of 2017, Intim is now being sold for a mere $1 billion, roughly 30% of its valuation at the time of acquisition. This transaction is expected to result in a $1.3 billion loss for Alibaba, symbolizing a significant financial setback. This move comes as the tech giant recalibrates its strategy in response to domestic pressure and aims to refocus on core operations, particularly its competitive e-commerce sector in China. Similarly, BlackBerry has taken a notable hit with its decision to sell the Cylance endpoint security unit to Arctic Wolf for just $160 million, plus a minor stock component. This figure starkly contrasts with the $1.4 billion paid in 2018, during a period of aggressive expansion. The disappointing performance of Cylance under BlackBerry's stewardship, which saw revenue halve and losses mount, necessitated this divestment. JustEatTakeaway.com NV's decision to offload Grubhub for $650 million, a substantial markdown from the $7.3 billion paid in 2020, further illustrates the trend. Acquired at the peak of the pandemic-driven demand for food delivery services, Grubhub's subsequent downturn forced a reevaluation of its worth, amidst a drastically altered market landscape with heightened competition and declining valuations. Experts like Oliver Sharping from Berenberg and Valeria Vitkova from Bayes Business School indicate that this wave of divestitures is not merely about cutting losses, but is part of a broader strategy to simplify corporate structures and enhance focus on core competencies. This strategic shift is bolstered by a reinvigorated M&A market, with overall volumes rising and more disciplined buyers entering the fray, drawn by lower asset prices and clearer investment theses. As these companies streamline their operations and shed underperforming assets, the M&A landscape is poised to further evolve. Cash-rich firms and private equity entities, sitting on substantial reserves, are likely to capitalize on these opportunities, picking assets at a fraction of their former valuations. This period of market correction, while painful for some in terms of financial losses, may ultimately lead to healthier, more focused corporate portfolios. As the economic context shifts away from the high-flying days of cheap capital and speculative deals, the current environment promises renewed discipline and potential for long-term corporate health. Thank you for choosing Satori News.